Hey guys, hope you had a wonderful day today. Yesterday, a lot happened regarding the Fed and their perception about the economy and inflation. The future regarding potential rate hikes is also not as bullish as the markets wanted. The stock market was down up until Nvidia absolutely crushed earnings, pushing the stock market up. Regardless, sentiment continues to lose confidence as each day that goes by, the potential for a debt default increases. Already banks are making moves to warn customers about what the outlook could be and what steps they should begin taking to protect themselves. We are going to go over everything that happened so that you have a good overview of the angle by which the Fed is looking at things. Before we start, let me quickly invite you all to my Discord. If you are looking to make passive income or day trade, there is not better place than our server. We provide the most accurate alerts for both day traders and those that want to make money more passively. The Discord is open to everyone, come see for yourself. That being said, let's get started. During their recent meeting, Federal Reserve officials had differing opinions on the future direction of interest rates. Some members believed that further rate increases were necessary, citing slow progress in reducing inflation. However, others anticipated a slowdown in economic growth, suggesting that there might not be a need for tightening monetary policy. While the decision to raise the Fed's benchmark rate was unanimous, the meeting summary revealed a leaning towards a less aggressive approach. The Federal Open Market Committee voted to remove a key phrase from their statement, indicating that additional policy tightening might not be needed. This suggests a shift towards a more data-dependent approach, where various factors will determine the continuation of the rate hiking cycle. The minutes highlighted uncertainty among participants regarding the appropriate level of policy tightening, with many emphasizing the importance of retaining flexibility. The debate essentially boiled down to two scenarios. Some members argued that inflation reduction was progressing too slowly, necessitating further rate hikes. On the other hand, several Federal Open Market Committee members believed that economic growth was slowing, suggesting that additional policy tightening might be unnecessary. The minutes did not specify individual members or provide precise numbers for some or several, but it is generally understood that some refers to a larger number than several. It was acknowledged that inflation remains substantially elevated compared to the central bank's target. While future expectations varied, there seemed to be a consensus that the previously anticipated path of 10 rate hikes, totaling 5 percentage points since March 20, 2022, was no longer certain. Participants recognized the risks to the committee's objectives of maximum employment and price stability, highlighting the importance of closely monitoring incoming information and its implications for the economic outlook. The minutes also touched on discussions about the challenges facing the banking industry, with the potential for multiple medium-sized institutions closing. Federal Open Market Committee members expressed readiness to utilize tools to ensure sufficient liquidity in the financial system. The minutes mentioned that in the March meeting, Fed economists had noted the potential for a credit contraction due to banking stress, which could lead to a recession. This assessment was reiterated in the May meeting, with the possibility of the contraction starting in the fourth quarter. However, it was also acknowledged that if the credit tightness subsided, it would pose an upside risk to economic growth. Additionally, the minutes briefly addressed talks regarding raising the national debt ceiling. Participants emphasized the importance of timely action to avoid adverse disruptions in the financial system and the broader economy. The release of the minutes coincided with varying public statements from officials regarding the future course of the Fed. Market expectations indicate that the May rate increase will be the last of this cycle, with the possibility of a rate reduction before year-end. However, most officials have expressed skepticism or dismissed the likelihood of a rate cut in the near future. Governor Christopher Waller stated that he leans towards more rate hikes to combat persistent high inflation unless there is clear evidence of inflation moving closer to the Fed's 2% objective. Chairman Jerome Powell also indicated little consideration for rate cuts, although he acknowledged that banking issues could influence the need for rate increases. Recent economic reports have shown a slight decrease in inflation, although it remains above the central bank's goals. The labor market remains robust, exerting pressure on prices, while wages have been rising. The economy, as indicated by purchasing managers' indexes, is currently showing signs of growth without immediate contraction. The Atlanta Fed's GDP Now tracker estimates a 2.9% annualized growth rate for the second quarter. I want to go over the biggest impressions from the minutes, and I will be quoting members directly. The biggest takeaways from the minutes were: the economic forecast prepared by the staff for the May FOMC meeting continued to assume that the effects of the expected further tightening in bank credit conditions, amid already tight financial conditions, would lead to a mild recession starting later this year, followed by a moderately paced recovery. Participants agreed that the U.S. banking system was sound and resilient. They commented that tighter credit conditions for households and businesses were likely to weigh on economic activity, hiring, and inflation. However, participants agreed that the extent of these effects remained uncertain. Participants generally anticipated that under appropriate monetary policy, imbalances in the labor market would gradually diminish, easing pressures on wages and prices. Participants agreed that inflation was unacceptably high. Many participants mentioned that it is essential that the debt limit be raised in a timely manner to avoid the risk of severely adverse dislocations in the financial system and the broader economy. Participants generally agreed that in light of the lagged effects of cumulative tightening in monetary policy and the potential effects on the economy of a further tightening in credit conditions, the extent to which additional increases in the target range may be appropriate after this meeting had become less certain. Participants generally expressed uncertainty about how much more policy tightening may be appropriate. Many participants focused on the need to retain optionality after this meeting. Some participants commented that, based on their expectations that progress in returning inflation to 2% could continue to be unacceptably slow, additional policy firming would likely be warranted at future meetings. Several participants noted that if the economy evolved along the lines of their current outlooks, then further policy firming after this meeting may not be necessary. Almost all participants stated that, with inflation still well above the committee's longer-run goal and the labor market remaining tight, upside risks to the inflation outlook remained a key factor shaping the policy outlook. A few participants noted that they also saw some downside risks to inflation. Let's talk about some developments regarding the potential for a debt default. I want you guys in on the scoop of every single thing happening as much as possible. I am using Bloomberg News to keep myself and you guys updated, so here's a summary of the latest development. House Speaker Kevin McCarthy expressed optimism on Wednesday that negotiators from the White House and the GOP would reach a deal in time to prevent a disastrous U.S. default. McCarthy's positive comments came after a 4-hour meeting between his team and President Biden's chosen negotiators, sparking hope that Congress would take action before June 1, the date when Treasury Secretary Janet Yellen warned that the U.S. might run out of funds to pay its obligations. Following the conclusion of the meeting, McCarthy stated, "I still think we have time to get an agreement and get it done." He also mentioned that there was no set time for him and President Biden to meet but expressed confidence that they would reconvene when appropriate. The negotiations between Biden's representatives and House Republicans commenced in the office suite of White House Budget Director Shalanda Young around noon. This change in location came after Republican negotiator Patrick McHenry boasted that all talks had been held in the Capitol, suggesting the GOP's advantageous position. The standoff has begun to affect the stock market, with the S&P 500 experiencing signs of concern, dropping 0.9% late Wednesday afternoon after a 1.1% decline on Tuesday. In the Treasury market, investors are demanding higher premiums on bills that mature when the government is perceived to be at the greatest risk of default. Rates on Treasury bills due on June 1 briefly surpassed 7%, comparable to yields on lower-grade debt. Treasury Secretary Yellen warned that the world is only witnessing the initial stages of potential market stress if the debt crisis persists. J.P. Morgan Chase chief U.S. economist, Michael Feroli, alerted clients that his team now places the odds of reaching the June 1 ex-date without a deal at around 25% and increasing. Yellen emphasized that the Biden administration's primary focus is on reaching a debt limit agreement rather than preparing for a default. She reiterated their commitment to avoiding missed payments and raising the debt ceiling. House Republicans have intensified their criticism of Biden for lacking urgency in negotiations, while a Democratic aide accused McCarthy of being unwilling to compromise on several contentious issues, jeopardizing the prospects of a deal. It is not uncommon for Congress to strike budget agreements at the last minute when the pressure becomes intense enough to force negotiators to make difficult choices. House lawmakers are expected to leave for the Memorial Day weekend on Thursday, but GOP leaders have requested that they be ready to return within 24 hours if a vote is scheduled. Economists predict that a default could push the U.S. into a recession, resulting in significant job losses and increased borrowing costs for consumers, which could impact the upcoming election year. Bloomberg Economics chief economist, Anna Wong, wrote, "The current standoff over the U.S. debt ceiling has the potential to wreak more havoc on the economy than any previous go-around. All in all, both Democrats and Republicans are saying they will not let the country default on the payments, which is good, Now if they can finally reach a deal and forego political games, we would certainly be much better off. Now, as you know, we have talked to death the subject of credit card debt and rising number of Americans defaulting on payments. Well, yesterday we got a fresh new report regarding how Americans are now coping, and it's not pretty. Buckle up, because we are going to get in dirty on this. According to the Federal Reserve Bank of New York, consumer credit card debt in the United States has surged to nearly $1 trillion. Over the course of 3 months ending in December, credit card balances increased by over $60 billion, resulting in a record high total of $986 billion in credit card debt. This substantial increase in credit card debt has coincided with rising interest rates, putting a strain on household budgets as inflation erodes the savings accumulated during the pandemic. WalletHub reports that the average credit card interest rate in the U.S. during the last quarter of 2022 was 21.6%, a significant jump from around 18% the previous year. The Federal Reserve's aggressive interest rate hikes have contributed to the escalation in credit card rates. Despite a robust job market with the lowest unemployment rate in over 50 years, the record credit card debt raises concerns about the financial well-being of U.S. borrowers. Wilbert van der Klauw, an economic research advisor at the New York Fed, highlights that while low unemployment has generally kept consumers financially stable, persistently high prices and increasing interest rates may challenge some borrowers' ability to repay their debts. Research firm TransUnion found that the average credit card user carried a balance of $5,805 in the last quarter of 2022, representing an 11% increase compared to the previous year. In an attempt to curb price hikes and slow the economy, the Federal Reserve recently implemented another round of interest rate increases. Although inflation has receded from its summer peak, it still exceeds the Federal Reserve's target of 2%. Despite indications of potential weakening consumer strength, government data released on Wednesday reveals a surge in retail sales in January. Retail sales experienced a 3% increase compared to the previous month, surpassing the 2% forecasted by Bloomberg's survey of economists. However, retail sales had declined in December, ending the typically busy holiday shopping season on a subdued note. Consumer prices rose by 6.4% in January compared to the previous year, showing a slight easing but remaining at elevated levels. Ted Rossman, a senior analyst at Bankrate specializing in the credit card industry, commented that many individuals may not have sufficient income to cover daily expenses, leading them to rely on credit cards. This creates a persistent cycle of debt for many people. Now, I do want to preface this by saying that Americans have not fully maxed out on credit card debt yet. Though the data we are watching is alarming, it is not yet panic mode. In the first quarter of 2023, the New York Fed's quarterly report on household debt and credit revealed that U.S. consumers' credit card debt did not experience the usual decline after the holiday season. Concurrently, total consumer debt surpassed $17 trillion for the first time, raising concerns among some journalists who interpreted it as a sign of financial strain due to high inflation and rising interest rates. However, it is important to note that delinquency transition rates, which measure the proportion of current debt becoming delinquent, have increased for most types of credit for the 5th consecutive quarter. Nevertheless, delinquency rates remain historically low, with less than 3% of total consumer debt being delinquent by at least 30 days. Additionally, one could argue that the absence of a decrease in credit card balances during the first quarter indicates strong consumer spending rather than financial distress. Nowadays, credit cards are primarily used as a payment method rather than a borrowing tool. Furthermore, unlike the government's situation with the debt ceiling, Americans are far from reaching their limit when it comes to credit card debt. With a total credit card balance of $986 billion and a total credit limit of $4.5 trillion, U.S. consumers still have $3.5 trillion of available credit remaining untapped on their cards. As you can see, it is not game over yet, but we are dangerously watching as millions of Americans rake up debt and thousands start committing delinquencies for not making payments on that debt. This is incredibly dangerous, especially given the fact that inflation is not cooling off at a pace that is not yet fast enough. And I am going to wrap things up here. Thank you for watching the video through its end. I will see you tomorrow. Let me know what you guys think in the comments below, and I will see you tomorrow on the last video of the week. Have a great rest of your day and to the moon.